to Nirmal Bang, ladies and gentlemen. I'm Hero Datia. We have with us Mr. Soumya Kanti Ghosh, Chief Economist Advisor at State Bank of India, joining in. Welcome to the show, Soumya. And it's always a pleasure to speak to you, get insights from you, and understand what's happening. In fact, a fantastic research report that you have come out with in terms of what's happening across economies, what's impacting emerging markets as well. So let's start off from a global perspective. Clearly, inflation, as you've also highlighted, is one of the major concerns across economies. Taking that question into consideration, that perspective into consideration, we are seeing a lot of aggressive monetary tightening that's happening across not only developed economies, but even developing economies. What's the sense that you pick up, and how do you see that transitioning from here on?
No, I think good afternoon, and it's great to speak to all of you. See, I just need to step back a little and explain the background. I think, as you know, that there has been a surge in inflation across the globe. And this time, I think the situation is that the developed economies are actually facing the brunt of an rampaging inflation, and emerging economies, including India, are also facing the wrath. But I think emerging economies like India are doing much better in terms of inflation management. If we just want to step back a little, I think the genesis of the problem of the inflation problem, of course, was the massive liquidity support with the central banks and the fiscal authorities across the globe unleashed following the pandemic. And after that, I think the developed economies which have been trying to push inflation beyond the threshold 2%, I think since 2008, had finally succeeded in pushing it, but they have pushed it beyond anybody's control and beyond the wildest of imagination which they could have ever thought of. And the problem is that as central banks will continue to raise rates, I think Fed meetings are scheduled tonight. Most probably the Fed could go ahead with a 75 basis point rate hike. There's some market consensus. ECB, if everyone is raising rates, the point to note is that I think no one knows what could be the end consequence. There is two schools of thought over here. I think the first school of thought, and which is a natural corollary, logical corollary, is that if the Fed continues to raise rates, I think what is going to happen is that this will bring down inflation after some point of time, but that will be cost of a higher unemployment, because that's the only way down, and demand compression. The other argument which is going through is now that the labor markets in the US are extremely tight. And as we have said in our report, the US unemployment rate is at very low levels. The vacancy rate at its very high levels. These two things coexisting implies that there is not sufficient job matching, which is maybe happening in the labor market in the US. And the Fed has little control over it. And in that circumstances, we may actually end up in a situation, if that continues, we may actually end up in a situation with high inflation, low growth, and that basically we call it stagflation. I'll not use the term stagflation, but at least that could be one of the consequences. The other consequence, as I said to you, could be a recession. But there are several studies which shows that recession in the US, the hard landing has not been so frequent, even in a rate increasing cycle. So in short, whatever is the consequences, the emerging economies will continue to be impacted, and that will be a challenge for any central bank of an emerging country.
Right. So, Soumya, would you say that the Fed is actually much behind schedule in terms of the rate hike cycle?
Yes, I think undoubtedly. I think this is, we have done our research. And even if I leave aside our research, there has been many studies in the US which are talking that Fed was actually significantly behind the curve. If you remember last year, the Fed had said that they have partitioned inflation into a transitory component and a permanent component. Only after the inflation started to break through, I think then the Fed realized possibly the folly, and that's why they started raise rates. And now the situation has gone to such a pass that Fed may have to hike in multiples of the 50, 75, and there was actually even talks of hiking it by 100. So that's actually the bottom line is now the Fed should have gone ahead and raised rates much earlier. But anyway, it has started the cycle. It is in a complete catch-up mode now. But the end game of this rate hike cycle, no one knows now in the world. So basically, there has been uncertainty in the global economy post the war, and this uncertainty will continue to plague the economies across the globe as the rate hike cycle continues.
Right. And even in terms of Europe, if we see, it's increased to 8.6% in terms of the June reading. High energy prices have been one of the key concerns as well. And the depreciation of the euro has also resulted, in terms of high inflationary pressures, right? And you have the prolonged war in terms of Ukraine as well as Russia. So, taking this into consideration now, and if you see in terms of how crude has moved, how are you seeing that parameter pan out from a Europe perspective?
See, Europe actually definitely is in the throes of an maybe a larger slowdown or a recession compared to US. And the ECB has finally admitted that inflation is a big problem in the Europe. And also the problem is that also with the gas issue, because of the conflicting war. And unfortunately, Europe being dragged into the war, even though it was not a part of the war, that has also hurt its economic prospects, because I think at the end of the day, gas is a lifeline for the for the European economies. And if winter comes and if the problem is not solved, that could bring about larger fears in European countries. As you know, that there have been stories that Germany is already trying to save the gas by switching off street lights after 8 a.m. and advising people to stay. So these are a lot of issues. And my sense is that Europe could face a larger problem, larger headwinds because of this conflict, and also because of the fact that in Europe also the central bank ECB has been even Fed has been all behind the curve, but ECB has been even further behind the curve, and that is one of the reasons that euro has been losing against the dollar.
Right. And with that, if you see in terms of Russia, we're talking of prices to stabilize in the range of $100 to $110 per barrel in the next couple of months. If that happens, how do you see also our domestic market from an inflation perspective? Because yes, RBI not only during COVID, but after that has been also pretty much proactive and has kept inflation and the rate hike cycle much in control. They've been able to manage the Indian rupee as well. So how are you seeing that inflation signaling, planning happening in terms of India?
No, in India, I think we have been saying repeatedly that inflation in India possibly has peaked. The peak was 7.79%. With a little bit of luck, I think the September inflation number, which could see the peak, may come below that 7.79%. So that's one. So that means that we have already passed the peak level of inflation. So that's a good thing. But we should keep guard against the fuel inflation. And my sense is that the crude oil prices still remains the elephant in the room. As you know, even in the commodity cycle, all prices have corrected by 25 to 30%.
Correct.
Crude is still holding above 100 levels, and the rally in the crude prices is being very short-lived. The moment it goes below 100, people think that now the crude price is going to decline, but again, it goes back over 100. And you have to understand also that China is in the grips of a significant lockup because of the COVID. So once China comes back into the market, there could be an increase in there could be an upside to the crude prices. So crude is the big elephant in the room. And given the fact that OPEC has said that it cannot increase production, so I think that is one space which we hope that crude prices will remain in this range, because even in this range, it is manageable because the RBI is working with an assumption of $105 per barrel. So even if it within the range, I think it should be okay for us. But I think beyond that, it could create problems also for the fiscal, because there will be pressures on the government to cut excise further. And that actually they could hurt government revenues also. So I think this is one very delicate balance which we are playing into.
Right. And overall, in terms of where the rupee goes, Soumya, clearly the depreciation has been modest as compared to what was happening with the dollar index, right? Do you think we are in the right direction in terms of managing the Indian rupee rate?
No, I think absolutely. And the most important parameter of the rupee performance is that the rupee depreciation, which has been of the order of around 5.5% since the war breakout, broke out, and the US dollar appreciation has been around more than 11%. So in a situation when the rupee depreciation is lower than the US dollar appreciation by such a significant amount, it means that the rupee has weakened because mostly of dollar strengthening. And that's the most important point. And in terms of the rupee management, I think, yes, the RBI has been doing the correct thing in trying to protect the rupee. There are fears in the market of the adequacy of the foreign exchange reserves, but I think those fears are overblown. Our total import cover is still at 9.5 months. That is a tad lower than the global average of 10.5 months. But you also need to understand that the significant decline in foreign exchange reserves, I understand that the foreign exchange reserves till the war broke out may have total foreign has maybe declined by more than 50 billion. But since the dollar has appreciated against all currencies significantly, I think a part of that the reserve decline is also because of the reserve revaluation. So I think that factor also has to be taken into consideration. I think it's anybody's guess what could be the amount of reserve revaluation, but I believe it's a big number, which we think it's a big number. So the bottom line is that if that is the case, the RBI will have further wherewithal to support the rupee in terms of its foreign exchange reserves, because now that ECB has been raising rates, the Fed will, as the Fed goes on to this rate increasing cycle, I think the dollar will start to weaken a little bit. And if that is the case, the rupee value, as all of you have seen, the rupee has appreciated a little bit. Today, it has declined a little more because of the Fed decision. But I think that could cap a significant downward spiral in the value of the rupee. But I think that there will be an uncertainty element in the value of the rupee. So you could see that the rupee gyrations will continue, because the forward premium is currently at a much manageable value of 3%. But my sense is that I don't rule out gyrations in the value of the rupee, even though I believe that the worst is possibly, we are very close to being the worst being over for the rupee.
Right. And from there on, if you move on the current account deficit perspective as well, clearly a deteriorating current account balance is what is the expectation from the IMF as well for all major economies, right? And do you think, firstly, India can be an exception? And if not, what is it that we're expecting? Because we've already recorded a 1.2% of GDP in FY22 as against a surplus of a 0.9% in 21. And the major concern has been the trade deficit. And if the trade deficit continues to widen right now, do you think that the government needs to probably start putting restrictions on non-essential imports?
This is basically a very tricky issue, and I don't think putting restrictions on imports will help us much. The problem is that the current account deficit is set to cross 100 billion for sure this year. The balance of payment deficit could be in excess of 50 billion. So these are very big numbers, and current account deficit could be possibly in excess of 3% of GDP. But the important point to note is that if you make an decomposition of Indian import basket into price effect and quantity effect, we will find that almost the entire increase in imports is because of this runaway increase in the crude prices. So therefore, and that's one of the reasons also we have said in our report that in certain circumstances when price effect dominates quantity effect, using exchange rate as an adjustment mechanism may not be the right thing to do. So therefore, I think my point is that we have to play out this regime. That's why I said at the beginning of the show that the crude prices holds the largest elephant in the room, and that is going to dictate India's imports in the coming months, and also the total size of the current account deficit. Let us hope that the crude remains range bound, and so that so the impact on these trade deficit remains under control.
Right. And again, on the currency front as well, clearly, as you've mentioned in your report as well, that RBI would not really have used more than $25 to $30 billion in defending the rupee. So do you think we have enough in terms of supporting the rupee through this channel right now? Is that room is still available?
No, I'll give you an example. I think India's total import cover is around 9.5 months. If you just do a deep stick, very simple study, I think Indian imports are currently around 50 to 60 billion. So that means that is one. So basically 1 month of import cover means 50 billion. So even if suppose we have to defend the rupee, even if the import cover goes up to 8.5 billion, I'm just saying it. That 1 month of import cover, which is 50 billion. So I think there is enough space in the foreign exchange reserves to defend the rupee. But I think the RBI has been doing the correct thing in terms of judicious intervention, and also the fact that RBI is intervening in the forward market, which doesn't entail forex intervention and liquidity withdrawal. So that is one of the strategies which the RBI has been doing recently to give a direction to the NDF market, because at the end of the day, the NDF market also dictates the domestic market. So that's a smart strategy which the central bank has employed. And I think more of that will continue in the future also.
Right. And another thing is, in terms of the RBI intervention, Soumya, the recent move to allow trade invoicing, payment, and settlement in rupee with willing partner nations, how big an opportunity or a game changer is this going to be? And do you think it'll have an immediate impact, or is it something which is from a longer term perspective?
No, I think it's most from a longer term perspective. Obviously, this is a positive move. And the important thing is that this move actually takes into consideration a whole lot of other things. For example, the proceeds of the money, the proceeds of the amount could also be invested in G6 and other things. So I think there is it is a balanced move. But my sense is that this to have a fair impact will actually take some amount of time, because these are all long-term measures which the Reserve Bank has been looking into. And please note that the Reserve Bank is also looking into introduction of the digital currency. So once the digital currency is also linked, I think that will also have an impact on all these measures. So these are all long-term measures, good measures, positive measures. But I think immediately maybe, impact on the foreign currency could be in terms of sentiment.
Right. And very lastly, the key event that all of us are now watching out for, Soumya, is the RBI policy. What's the expectation according to you in terms of rate hike? How do you expect the stance to change? And what is it that we should be watching out for?
No, I think the RBI is definitely going to raise rates in the August policy, possibly one more rate hike in the October policy, because the RBI has been pushing for pushing for front-loaded rate hikes, and that has been also clearly spelled out in one of the RBI papers. Although this is in the RBI monthly bulletin, but that gives out a vision what the RBI wants to do. My sense is that the August could see a rate hike less than 50 basis points, because the RBI would also like to give a message to the market that we are getting the inflation, we're getting a grip on the inflation. So maybe if the RBI goes for a rate hike maybe of 50 basis points, so as to match the rate hikes of the central banks across developed economies, that could also fuel a self-fulfilling prophecy among the speculators. So that is another thing which the central bank would need into. But definitely there will be rate increases in the August policy and October policy, because the only way to beat inflation and inflation persistence, as we have also said in the paper, is to go for aggressive rate hikes. Because once the inflation, because the damage which an inflation persistence does is much higher than if suppose if there was no inflation persistence, and even if you still raise the rates, it's more than that damage. So I think that it's doing the correct thing. And lastly, next year inflation is going to be lower than 5% as per several projections. So if that is the case, and if we get to the terminal rate of 5.5% and above, we should be already in a positive real rate territory of 50 basis points and above. So I think this is what the scenario looks like. It depends on what the central bank believes. But my sense is that possibly if the inflation peak of the inflation is over, the Reserve Bank of India will take it step by step. But definitely the hikes will be front-loaded.
Right. And my last question, Soumya, coming to you, is from an economy perspective. Do you think India is in a better place versus the others?
No, India is in a better place. If you look into the leading indicators, there was a dip in the month of April, but in May and June, the indicators have actually moved up, even though the percentage of leading indicators which are in acceleration mode are lower than what it was in before the war, but still it is going up. So that means that there has been an impact on the economy, but we have been somehow able to manage and navigate through it better than the other countries, because we are not facing an inflation persistence of the
Correct.
levels which the other countries are facing. So if that is the case, I think maybe with a little bit of luck, we may be able to come out of this the global rate increase war and other wars in a better shape. And also you need to understand that throughout the pandemic, the trade actually has not declined. If you look into the data, the trade has continued to remain buoyant in the last 2 years. So if that is the case, the export story which India has been doing so well in the last year may continue to do well. Imports, of course, will be an issue because of the higher price effect, but that is one thing which we have to live with.
Absolutely. So overall, yes, seems to be we're in a much better place. And I think only improvement and actions in the right direction will help us hold strong. Thank you, Soumya, so much for joining us on the show. I hope you enjoyed the discussion as well. Thank you. Stay safe and speak to you soon again.
Thank you so much. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.